Hi guys, welcome back. We'll continue our tutorial on guide to looking at charts. If you've just joined us at this point, perhaps if you look at the previous tutorials to catch up on where we are. Now, in this tutorial, we'll be looking at what then do you do after the strongest trend or the strongest trend pairs are picked. How do you decide which one to trade? So in a sense, in the previous tutorials we looked at how to pick the strongest pairs. We discounted some. Now that we've got the strongest ones, or what we think are the strongest ones, how do we decide which one to trade? Now there are two characteristics of a solid trading opportunity. The first one is after a pullback against the dominant trend has taken place, enter when the trend resumes. And the second one is a break of the support or the resistance in the direction of the trend. So those are two different ways to enter the market. So you wait for a pullback against the dominant trend, and then once that pullback has taken place and the trend has resumed, then you go into the market. You get into the market. Or the second one, you wait for a break of the support or the resistance in the direction of that particular trend. So here is a downward trend. We talked about oscillators. In this case, we've got the slow stochastics. Now, what are these oscillators, and especially like the stochastic that we've got in front of us? What is it about? By the way, this is the oscillator. Now, I'll just give you a quick rundown of what the oscillator is. Now, it is based on the observation that as prices increase, closing prices tend to be closer to the upper end of the price range. Conversely, in downtrends, the closing price tends to be nearer the lower end of the range. Two lines are used in the stochastic process, the K line and the D line. The D line is the more important, as is the one that provides the major signals. So you can see that it fluctuates between that line and that line. And obviously you can see there are two lines there. And then those are the two main ways to sort of look at it, in the sense that this provides an added signal of when to get into the market. So in a sense, you're looking for confirmations. You've looked at the trend, you've identified as a downtrend. You're looking at it's making lower and lower lows. You can see a pullback there. Then you look for additional confirmation from your oscillator. Now it is at this high level here. Once it turns and then starts moving in the downward direction, in the direction of the trend, which is downwards, that is the time to enter into the market. So that gives you a signal. So you just find that there are places that where these do coincide. What you're looking for is where, like in this downtrend, the point at which they actually coincide with the upper line and then turning downwards. That's your signal, because we will look to enter the market in the direction of the trend, not against the trend, but in the direction of the trend. So in a sense, downwards. So so this currency pair, you'll be looking to sell or to go short once you get a confirmation from your oscillator that the market has reversed. Like at that point there, you can see the two of them do completely match. So as this turns down, then straight away you know that's your signal to sell the market, or to sell the market, or to go short. That's the word I was looking for. Just a little bit more on the theoretical underpinning of this oscillator. What it really does is it gives you on percentage pages from 0 to 100 where the closing prices are in relation to the total price range for a selected time period. A very high reading over 80 will put the closing price near the top of the range. That is the 80 line there, while a low reading under 20 very near the bottom of the range. Now the two lines oscillate between the vertical scale from 0 to 100. The K line is the faster line, while the D line is the slower line. The major signal to watch for really is when it crosses these the upper and lower extremes, which are 20 and 20 and 80. Then that gives you an indication that you can enter the market itself. And suffice to say as well that many traders use there is the fast stochastics, but many traders believe that the slow stochastics gives more reliable signal. So let us drill a little bit into the chart by zooming in a bit. As you can see on this chart, once the two lines cross and start going downwards in direction of the trend, like we have said, we'll always trade in the direction of the trend because we've got our trend, which obviously, first of all, you can see the 200 simple moving average there. It is below. We've identified this is a downwards trend. Now we want to enter into this market in the direction of the trend. Now at this point here, you see that candle. You can enter into the market, and then you put your stop loss at the nearest level of resistance, which was here. Now this line here forms a very psychological barrier, so to speak, because at prices have at 2 points, you can see there and there, the prices have failed to exceed that particular line. So if you go into the market at this point and you put your stop loss just a little beyond that line, you will just find that if you have got it right, obviously the price will continue to move down, and if you have got it wrong, or the prices change, or the market moves against you, it will stop you out. Now it's always good to get into the market with a stop. At any point in terms of trading, you have to determine what the stop should be, and then where you would want, in a sense, you've got to look at your risk-reward ratio. We'll talk about this in money management later on in a future tutorial. But suffice to say, you get into the market, ensure that you put a stop, which is so that if the market does go against you, then obviously you're stopped out. It's better to do that so that you don't incur losses should the market continue to go in the opposite direction to what you have traded. We will stop this tutorial here, and we will continue in the next tutorial. We will look at the second method of entry into the market.